Welcome back to Investing Talk podcast.
Today we're looking at Navitas Semiconductor. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Navitas. This one's interesting. There's this real tension,
Tension how?
between what's happening right now financially and what they hope will happen. The big theme is, well, they're shrinking on purpose.
Shrinking to grow.
Pretty much. Management's taken this massive short-term hit, cutting revenue, so they can reposition the whole company for potentially huge long-term growth. It's a big gamble.
Okay, and you really see that gamble in the recent numbers.
Yeah.
That short-term pain is, well, it's obvious.
It is.
Q3 2025 revenue came in around $10.11 million. Now, that beats estimates slightly, but
But the year-over-year is the key.
exactly. Down from $21.7 million last year. Wow, that's more than halved.
And it's deliberate. That's the thing. They're actively walking away from certain business lines.
Which ones?
Lower margin stuff.
Yeah.
Specifically, China, mobile, and consumer segments. They basically decided that business was, I guess, holding them back.
Right, preventing them focusing on the higher value areas.
Precisely. So they're pivoting away, surgically removing it, you could say.
And the Q4 guidance really hammers this home, doesn't it?
It does. They guided revenue for Q4 to between, what was it, $6.75 and $7.25 million.
Yeah, somewhere in that range. And consensus was expecting over $10 million.
So way lower. This isn't just like a minor adjustment. It's a full-on restructuring of where the money comes from. A controlled demolition, maybe?
It sounds incredibly aggressive and risky.
Oh, absolutely. Major execution risk. They're chopping off like half their guaranteed revenue
Based on promise.
based on the promise of landing bigger, better deals later on. And the bottom line shows this too. Q3 adjusted net loss, 0.05 cents per share. That was expected, but still.
Still losing money. Negative cash.
Yep. It's an investment phase. Pure and simple.
Okay, so if the financials look, frankly, pretty rough right now, why would an investor stick around? What's the opportunity? Where's the edge?
The edge is all in the technology. Navitas is, they're positioned as a leader, maybe the leader, in next-gen power electronics.
We're talking gallium nitride and silicon carbide.
Exactly. GaN and SiC. This isn't just, a slightly better version of the old stuff. It's fundamentally different materials for managing power.
Can you break that down a bit? Why GaN over traditional silicon?
Sure. So think about efficiency and size. Old
Yeah.
silicon chips have limits, right? How fast they switch, how hot they get.
Okay.
GaN and SiC, they're what's called wide bandgap semiconductors. Basically means they handle much higher power in smaller spaces, switch way faster, and run cooler.
So perfect for things that need tons of power but need it managed really efficiently, like EVs, data centers.
Precisely. If you're building an AI factory that uses megawatts of power or designing an electric car's powertrain, you want components that are smaller, lighter, faster, and waste less energy as heat.
Makes sense. Those efficiency gains must really add up at scale.
They do, big time. Especially massive data centers or across industrial electrification. Saves huge amounts on energy bills, cooling costs. Navitas is aiming its tech squarely at these markets: AI data centers, industrial electrification, and EVs. Big growing markets.
Which makes that cash cushion they have about $150 million. Right. Absolutely critical.
Totally critical. It's their lifeline. It buys in the time, maybe, 8 to 10 quarters to actually make this pivot work before the big contracts really start paying off.
Right, until the revenue hopefully catches up with the strategy.
Exactly. But let's talk about the proof point. The thing that shows this might actually work, the AI catalyst.
Ah, the NVIDIA connection. That got a lot of attention. What exactly did they secure there?
It was a major design win. Huge validation. Navitas is providing new GaN FETs and high-voltage SiC components specifically for NVIDIA's high-power AI factory architecture, the 800-volt system.
800 volts. Yeah, that's serious power for AI training, not consumer stuff.
Definitely not. It shows their tech can handle the most demanding, cutting-edge applications out there. It's a massive stamp of approval for their high-power strategy.
And the strategy shift ties into the leadership change too, doesn't it?
It does. Bringing in Chris Alexander as the new president and CEO.
What does that signal?
It signals focus. He's a semiconductor industry veteran. His job is clearly to accelerate growth, specifically in those high-power areas we talked about: AI, EV, industrial.
So putting experience behind the pivot, moving from maybe consumer-ish focus to high-reliability infrastructure.
Exactly. Realigning the whole company's expertise.
Okay, so strategy shift, tech leadership, a big NVIDIA win. How's the market actually treating the stock through all this? It recently closed around $13.46, but volatility is the name of the game here, right?
Oh, it's a wild ride, a total roller coaster. The 3-month range is something like $1.52 up to nearly $18.
Wow, $1.52 to almost $18. That's extreme.
Extremely volatile. And the beta reflects that it's super high, 3.10.
So for listeners, a beta of 3.1 means it moves roughly 3 times as much as the overall market.
Theoretically, yes.
Hmm.
If the S&P 500 moves 1%, Navitas might move 3.1% up or down. So when things are good, it flies. When the market gets nervous,
It gets crushed.
pretty much. That's the risk profile you accept with this kind of story.
But technically, despite that volatility, the momentum since that low has looked pretty strong.
Yeah, technically it looks better. You've seen accumulation, signs of a bullish trend emerging, suggests maybe the market is starting to buy into the long-term story, even with the current financial headwinds.
Which leads to this really weird situation with the analysts.
Right, it's a paradox.
Yeah.
Sentiment is actually quite positive. 7 analysts cover it, and they pretty much all rate it a buy.
Strong consensus,
But the average price target from those same analysts is $5.50.
$5.50. When the stock is trading above $13, that makes no sense.
It's one of the biggest disconnects you'll see. What's going on? Well, maybe a couple of things.
Okay.
Possibility 1. The analysts are just behind the curve. The NVIDIA news, the stock's huge run-up, maybe their models haven't caught up to the strategic shift yet. That takes time.
Okay, that's the optimistic view. The other possibility.
The more cautious view is that the market might be getting way ahead of itself. Maybe the analysts are right to be concerned about the ongoing revenue drop, or maybe they're factoring in the risk that Navitas doesn't land enough big follow-on deals quickly.
So the analysts see more near-term execution risk than the current stock price reflects.
Potentially. It's definitely a warning sign that the stock price might have run up faster than the proven fundamentals.
That makes the next few months critical then. What are the key catalysts investors should watch?
The checkpoints. Number 1 is definitely the Q4 earnings release. Probably around mid-January 2026. That's a first chance for management to really show progress on the new strategy, maybe give guidance that reflects actual growth in AI and EV.
Need to see the pivot translating into forward-looking numbers?
Exactly. And beyond earnings. Watch for more news, more design wins.
Like another big data center player or a major car company.
Yes. Landing another big name like NVIDIA or a major automotive OEM would significantly de-risk the whole story. That external validation is key.
And don't forget that volatility. You mentioned the Nasdaq ETF rebalancing.
Right, November 15th. That could cause some short-term swings just due to fund flows given the high beta. Something to be aware of.
Okay, so let's clearly state the risks again. We mentioned execution risk.
Massive execution risk. It all hinges on securing those big new contracts in AI and EV if they're slow to land them or if a competitor beats them to it.
That $150 million cash cushion starts to look less comfortable.
Very quickly. The negative cash flow will eat into it fast if the revenue doesn't ramp up as planned. That's the core risk, dependence on future wins.
And there's also some speculative buzz floating around, isn't there? Unconfirmed, but still.
Yeah, the usual M&A chatter. You always hear whispers about a bigger fish potentially acquiring Navitas to get their hands on that Gansik tech expertise quickly.
Acquisition rumors often put a bit of a floor under a stock price.
Sometimes. And there's also talk about them maybe pushing even harder into specific EV power systems where there are bottlenecks. But again, that's more speculative.
So pulling it all together, the tech lead, the huge market opportunity, the NVIDIA validation, but also the shrinking revenue, the execution risk, the volatility. What's the final assessment? Where do you land on Navitas right now?
Overall, I'm actually bullish. I'd rate it maybe a 7.5 out of 10, but with significant caveats about the risk.
A 7.5. Why so high, given the near-term pain?
Because of the sheer size of the opportunity and the trends behind it. AI infrastructure, the EV transition, industrial energy efficiency. These are massive multi-decade tailwinds.
And Navitas is positioned right in the middle of it with key tech.
Exactly. It's one of the few pure-play ways to invest directly in that advanced power semiconductor shift. And crucially, management isn't waiting around. They're actively, if painfully, repositioning the company now to capture that future. It's proactive.
Okay, so who is this actually for then, if someone's listening and considering it?
Well, it's definitely not for the faint of heart or the conservative investor. I see 2 main groups. First, maybe short-term traders playing the volatility and the catalysts.
Riding the waves.
Yeah. But the main appeal, I think, is for long-term investors with a high tolerance for risk. People who believe in the Ganzicki story over the next, say, 3 to 5 years and are willing to bet on this management team pulling off the pivot.
You're betting on execution over the next couple of years, really.
That's the core bet.
So ultimately, the story of Navitas Semiconductor right now is one of strategic sacrifice. They're giving up today's revenue for a chance at dominating much bigger markets tomorrow. The question isn't really if the technology is important, it clearly is, but whether this new leadership can navigate this tricky transition fast enough before that cash runs low or the market loses faith.